Greetings, this is Catherine Morgan-Nance. The term capital budgeting is used to describe how managers plan for significant cash outlays on projects that have long-term implications, such as the purchase of new equipment and the introduction of new products. This video series introduces several methods used by managers to make capital budgeting decisions, including a brief overview of the time value of money. We'll start first with a general overview of capital budgeting concepts. Capital budgeting helps managers evaluate whether an outlay of money today provides an adequate return in the future. Most projects should provide a return of the initial amount invested plus a minimum return on the amount invested. Capital budgeting helps managers plan for significant investments in projects that have long-term implications. Capital budgeting analysis can be used for any decision that involves an outlay now in order to obtain some future return. Typical capital budgeting decisions include some of the following. Expansion decisions. Should a new plant or warehouse be purchased to increase capacity and sales? Or equipment selection decisions. Which of several available machines should be purchased? Third, equipment replacement decisions. Should old equipment be replaced now or later? Fourth, lease or buy decisions. Should new equipment be leased or purchased? And finally, cost reduction decisions. Should new equipment be purchased to reduce costs? Managers recognize the significance of the time value of money when evaluating investment opportunities. That is, they understand that a dollar today is worth more than a dollar a year from now. It's a pretty basic idea. If we put a dollar in the bank today, it will earn an additional return, called interest, during that year. So we will get more than a dollar back at the end of the year. Therefore, projects that promise earlier returns are preferable to those that promise later returns. The capital budgeting techniques that best recognize the time value of money are those that involve discounted cash flows. We will talk more about the time value of money in an upcoming video. Managers make two types of capital budgeting decisions: screening decisions and preference decisions. Screening decisions relate to whether a proposed project passes a preset hurdle. For example, a company may have a policy of accepting projects only if they promise a return of 20% on the investment. We will consider two methods used for screening decisions. First, the payback method, which evaluates only the cash flows of a project, and second, the simple rate of return method, which calculates incremental net income using the accrual basis of accounting rather than focusing on cash flows. Both of these methods ignore the time value of money and will be considered in a subsequent video. Preference decisions select from among several competing courses of action. For example, a company may be evaluating which of several different machines should replace an existing machine on an assembly line. In your personal life, a preference decision could involve whether you lease or buy your next car. Preference decisions are more detailed than screening decisions and often do emphasize the time value of money. We will demonstrate the net present value method in a little while. First, I recommend you watch the next video in this series, which covers a very important financial concept often referred to as the time value of money. See you soon.